A storm is coming, but it all has consequences, and I think we're about to witness a financial tempest that will reshape the U.S. real estate landscape. In this video, brought to you by the Elite Economizer, we're diving deep into the looming crisis billionaire investor Warren Buffett is warning people about. This $1.4 trillion debt-fueled storm has already started to ripple through the real estate market, and the implications are staggering. Watch as we unravel the intricacies of this impending disaster and how it might affect you. Buffett's warning. To set the stage, let's revisit the recent words of Warren Buffett, a name synonymous with wise investment decisions. In response to a question from Tom Seymour, Buffett addressed a Financial Times article quoting his partner Charlie Munger, who had sounded the alarm about a brewing storm in the U.S. commercial property market. Munger was concerned about American banks holding a substantial amount of what he described as bad loans, especially as property prices began to slide. We'll dissect what's happening in the commercial real estate sector, gauge the severity of potential losses, and pinpoint the sectors or regions that might be hit the hardest. Additionally, we'll explore whether Berkshire Hathaway, Buffett's conglomerate, might shift its stance on commercial real estate investments due to these impending challenges. A look at commercial real estate. Before we delve into the storm, let's understand the terrain. Commercial real estate involves properties used solely for business purposes, such as office buildings, retail spaces, apartment complexes, and warehouses. Unlike residential real estate, which often sees fixed-rate mortgages, commercial loans come with a unique feature. They typically reset every 3 to 5 years, subjecting borrowers to prevailing interest rates. This trait brings an element of uncertainty that homeowners don't usually experience. The role of cheap debt. Over the last 15 years, the U.S. real estate market has experienced an unprecedented surge, driven in large part by historically low interest rates. A quick glance at the U.S. federal funds effective rate, which serves as a proxy for economy-wide interest rates, reveals a prolonged period of near-zero rates. These rock-bottom rates have been a catalyst for investors and businesses to leverage cheap debt to purchase real estate. But as we know, easy money often comes at a price. Let's break it down with an example. Imagine someone buying an office building in your hometown for a nice round figure of $1 million. Chances are they don't have $1 million stashed away. Instead, they turn to a bank for a loan, contributing $350,000 as equity and securing a loan for the remaining $650,000. This approach, though common, comes with inherent risks, especially when interest rates are involved. Interest rates and debt payments. In our example, suppose our buyer secures an interest-only loan at a 5% rate. This implies an annual interest payment of $32,500. However, whether this purchase is profitable hinges on the property's net operating income, essentially the rent generated minus ownership and management expenses. Let's assume the property generates a comfortable $60,000 annually, which more than covers the $32,500 interest payment. This situation represents the rosy side of the equation, where low interest rates make property ownership financially sound, the interest rate tightrope. But what happens when interest rates climb? Consider our example again, but with an interest rate hike from 5% to 7%. Suddenly, the annual debt payment soars to $45,500, making the property less profitable. Jump up to a 9% interest rate, and the annual debt payment becomes a whopping $58,500. Even if the property maintains its $60,000 income, the owner faces financial strain. The remote work revolution. Now, layer in the remote work revolution. With the rise of remote work, the demand for office space has dwindled, potentially permanently. In our scenario, let's assume the property's income drops from $60,000 to $40,000 due to lease non-renewals and increased vacancy. Now, the property's income isn't sufficient to cover the $58,500 debt payment, setting the stage for a possible foreclosure. Non-recourse loans. At this point, you might be wondering if these borrowers are personally liable for the debt. For residential mortgages, borrowers often sign personal guarantees, holding them accountable regardless of the property's value. However, commercial real estate transactions often involve non-recourse loans. In these cases, the owner can surrender the property to the lender and their liability is limited to the collateral, the property itself. This aspect complicates the situation further. A wave of defaults. The real estate market is on the brink of a perfect storm, and we're already seeing signs. One prominent example is Starwood, a major real estate investment firm, which recently defaulted on a $212 million loan for an office building in Atlanta. Once a prime piece of real estate, the property now struggles at only 60% occupancy, down from 90% when the loan was issued in 2018. Starwood chose not to negotiate a deal with the lender and instead handed back the keys to the building, a sign of the times. Small banks and the domino effect. As we navigate these financial waters, it's crucial to understand the role of banks. While you might assume that Wall Street giants dominate real estate lending, the reality is quite different. Small regional and community banks are the unsung heroes, responsible for around 2/3 of all commercial real estate loans. These small banks play a significant role in supporting small and medium-sized businesses, the backbone of local economies. As these banks grapple with losses from commercial real estate lending, they may inadvertently constrict the flow of capital to small and medium-sized businesses. This ripple effect could stifle growth, hiring, and economic vitality in communities across the nation. In conclusion, storm clouds are gathering over the U.S. commercial real estate market. The legacy of cheap debt, coupled with the unpredictability of interest rates and changing office dynamics, has set the stage for a complex crisis. As Charlie Munger wisely noted, the buildings don't go away, but the owners do. In the coming months, we'll watch as the consequences unfold and wonder who will bear the ultimate burden. The future of commercial real estate. While we've painted a grim picture of the current state of the commercial real estate market, it's essential to consider what the future might hold. Will the storm pass, leaving the market relatively unscathed, or are we on the cusp of a fundamental shift in how we view and utilize commercial properties? Adapting to change. One thing is certain: the real estate industry must adapt to the changing landscape. The remote work trend has accelerated the need for flexible office spaces. Some commercial property owners have started to repurpose their buildings into co-working spaces, which cater to the needs of a distributed workforce. This adaptability might be the key to survival for many commercial property owners. Technology's role. Technology is also playing a crucial role in the transformation of commercial real estate. Property management platforms are becoming more sophisticated, allowing owners to optimize their operations and reduce costs. Smart buildings equipped with IoT devices can improve energy efficiency and provide valuable data on occupancy and usage patterns, helping owners make informed decisions. The resilience of certain sectors. While the office sector is facing significant challenges, other segments of the commercial real estate market are proving to be more resilient. The industrial and logistics sector, driven by the growth of e-commerce, has seen increasing demand for warehouses and distribution centers. Similarly, the multifamily residential sector continues to show strength, as people always need places to live. Government intervention. Government policies can also play a role in stabilizing the commercial real estate market. Stimulus packages and support for small businesses can help alleviate some of the financial pressures faced by property owners and tenants. However, these measures are often temporary and may not address the long-term structural issues facing the industry. Investment opportunities. For savvy investors, a crisis in the real estate market can present opportunities. Distressed properties may become available at lower prices, offering potential for significant returns when the market eventually recovers. However, investing in commercial real estate during uncertain times requires careful due diligence and risk assessment. The human element. Behind the numbers in financial transactions, it's essential to remember the human element in commercial real estate. Tenants and property owners are facing challenges that can impact their livelihoods and financial well-being. Empathy and collaboration will be key in finding solutions that benefit all stakeholders. Looking ahead. As we navigate the storm in the commercial real estate market, one thing remains clear: the landscape is changing and adaptability will be critical for survival. Whether it's repurposing office spaces, embracing technology, or exploring new investment opportunities, the industry must evolve to meet the demands of a post-pandemic world. Only time will tell how the tempest will reshape the U.S. real estate landscape, but one thing is certain: it won't be the same as before. Thank you for joining us at the Elite Economizer. Don't forget to like this video and subscribe for more insightful content that helps you navigate the world of finance and investment.